Ironically, infinite banking is not infinite, but it can still be a very cool strategy for you. So in this video, I'm going to share 4 important points that you need to know that will help you get the best infinite banking policy in your situation right now. All right, so let's just start off with this. Who is infinite banking not for, right? We always have people out there saying like, this is the best thing since sliced bread, or I don't even know how sliced bread even came up. But anyways, this is the best thing ever, right? So here's who it's not for. I'll tell you, one, if you can't save at least $5,000 or $10,000 a year, I wouldn't do it. That's where term insurance can be a great strategy. Yes, I said it. Term insurance can be awesome. In fact, we do it for a lot of people. I'll tell you though, if you get term insurance, get a convertible term insurance policy that you know you can convert to a really good infinite banking policy. And just so you know, not all insurance companies are good. In fact, very few of them are actually good at this strategy. So you want to make sure you get a convertible one to a policy that you eventually want. But if you can't save at least $5,000 or $10,000 a year, I wouldn't even worry about this strategy. Build that cash flow up. To get a term insurance policy, just do it that way. So that's the first person that's not good for. Secondly, if you're over the age of 70, hey, the older you get, the less the returns are in these kind of plans. Now, you might have an insurance need, we get that, but we may not use this specific strategy to help you with it. So if you're over the age of 70, I wouldn't do it. And then the third thing is if you're in poor health. And I mean like if you recently had, like maybe cancer or something like that, luckily we're happy that you're still here. But if you had cancer or something like that, if you've been in a situation where you're extremely overweight, maybe you've had bad heart conditions, maybe you're just a smoker. If you're in any of these kind of categories, the costs are going to just pillage all the money out of your plan to pay for the insurance versus helping pay you for this to actually work, to really make more money off of it. So that's one thing. So if you're in poor health, then I'd probably recommend that this may or may not be the best thing for you other than just getting a basic death benefit to cover your needs. Now, I will say this. I did have one client that came to me. He says, Chris, I'm a dentist, but the problem is I'm over 300 pounds. I'm in my 50s. Even though he wasn't too old, still, he was just in bad health. He's like, I already know my health is horrible. Even if I get approved, it's going to be expensive. What can I do? And I said, well, are you married? Yeah, I've been married. And I said, great. How's your wife's health? He said, oh, her health is great, way better than mine. Oh, and by the way, she's 52 years old. I said, even better, because she's younger, she's healthier, and just so you know, women live longer. So for that reason alone, even if she was the same age, she would still kick the crap out of your policy. So she would be your best bet. And so what did he start doing? They started paying over 100 grand a year into her policy, into her name. So again, even if you're not someone who is in good health, maybe you're not in a position where maybe you're older, maybe you're over the age of 70, and this may not be a good option for you, you might have other options with other family members, business partners, anybody who you have a financial interest in. You might be able to get a plan on them and make it work for you still. So again, the 3 people that this is not for, basically you can't save any money, you don't have 2 nickels rubbed together, 2, you're in bad health, or 3, you're over the age of 70. Now, for the rest of you, who is this for, right? The rest of you that can make this work, let's talk a little bit more about how this actually does work for you. Now, this is what I recommend people do if you've got at least a little bit of cash to start a policy. Now, many people say, I don't want to have this net cost, because I'll tell you, the real secret of these policies, whole life in general, whole life insurance policies are front-loaded in their costs, right? It's the most expensive in those first few years. Usually the first 3 to 4 years are the most expensive. But after that, they drastically reduce. It gets cheaper. Where term insurance gets more expensive over time, whole life gets cheaper over time. So this first few years, I recommend using your emergency fund. Now, if you don't have an emergency fund, well, then we might want to try to redo this design a little bit differently, right? But if you've got an emergency fund, say you've got your 6 months reserves saved up, and say that 6 months reserves is $50,000, right? You got $50,000 saved up. What I would do is instead, I would take some of that money to pay for the first 2 or 3 years of your policy. So even though you're adding money into your savings account, I have a lot of clients, by the way, they'll actually stop funding their 401ks so they can fund this, so then they don't have to wait till they're 60,000 plus years old to use it. They can actually use their money to make them money today, especially if you want passive income right now. Putting in your company's 401k, regardless of the match, which barely makes up for the bad performance of 401ks anyways, regardless of that, they can actually make money now versus waiting until they're in their 60s or later, if they even live that long. And so a lot of people will actually stop funding their 401k to fund this instead. But again, if you use the first 2 or 3 years to just use your savings account to pay into it, to diversify your savings so you're not just making 0.nothing%, but now you can make 5 or 6% return on your money tax-free, that's a much better way to go. So a lot of people actually use their emergency fund to fund it for the first few years, which has a net cost to it. And then after that point, it's already paying for itself. Usually after like 3 or 4 years into the policy, it's making more than what you're paying into it. So it's almost like it's free insurance at that point because it's growing by more than what you have going in. Also, what this allows you to do too is if you have other money to use to invest, I have my clients actually invest that money now. So many people get caught up because they watch these videos. Maybe you watch other infinite banking videos and they talk about throwing all your money in here and then investing with it. I don't agree with that. I don't think you should because I'm an investor first and foremost. I actually like to get all my money invested I can. So like I said, I use my emergency fund to start the policy for those first few years while using all the other cash. Let's be honest, I'm not going to use my emergency fund to invest anyways. That's going to be kept safe in a savings account. But instead, get that money in the policy, make a little bit better returns there, and then I use the rest of the money to invest all of that. And guess what? When I invest that money out there, that money starts coming back to pay me cash flow and returns. So if I'm making, say I had $250,000 that now is making me $25,000 a year, I take that $25,000 and I'm reinvesting for a few years. That also gives me more than enough cash to keep paying my premiums anyways, because that premium probably would only be about $20,000 or $25,000 a year. So the cool thing is, even by the time that it comes to where I could actually have to use my own cash, I've got enough cash flow coming in to pay my premiums for me. It's like a zero net cost out of my own pocket. So that's kind of the different nuances you can do. And again, this is why I recommend you reach out to us on our website, moneyripples.com, just to figure out how that works in your situation. Which, by the way, just so you know, I'm going to tell you to do that again at the end. So just be sure to do that. Now, here's some other things to be aware of as well. Many people will say, well, how much should I be putting in? Kind of like what I was alluding to before. Here's some basic guidelines. It's not perfect, right? There's different nuances here, but here's some basic guidelines you can use. For example, if someone tells me, Chris, I'm saving $20,000 a year into my savings accounts or my 401ks and everything else, that's what I'm saving, I'd say, awesome. Well, then we're not going to do a policy that has a max limit of $20,000 a year. We're probably going to put it a little bit less. Maybe it's like $15,000 or $16,000. Usually it's like somewhere around 75 to 80% of whatever you're saving, I would recommend putting into the plan. Now, the cool thing is, the way that we design our plans with this max ROI infinite banking strategy is that it's not like the typical life insurance. The typical whole life policy, whatever is your minimum is also your maximum. So if they tell you, like my first policy that got set up to me by an insurance agent that really wasn't in my best interest, he was having me paying $1,000 a month. But if I didn't have $1,000 to pay that month, it didn't matter. I had to pay it. If I didn't pay it, I lost the policy. That was a very stressful situation to be in, especially when 2008 kicked my butt and I didn't have the money to keep paying those premiums. I had paid in $25,000 to then lose all that insurance. That was like the most expensive rip-off ever. When Dave Ramsey rips on whole life insurance, he is right when it comes to things like that. However, if you design it the right way, you design it where, say that max is $16,000 a year that you're putting in. Well, did you know that the minimum, depending on your age and health rating, might only be about $3,000 a year or so, maybe $3,000 or $4,000 a year. So that's all you're required to put in. So you have this max limit that you can put in up to, and then you have a minimum as well. So even if you try to put in $20,000, your minimum might be somewhere around $4,000 or $5,000 a year. That's what's required. So if you maybe you have a good year, $20,000 is easy. But if you have a bad year, as long as you pay at least $3,000 or $4,000, you're okay. So here's the worst case position, right? If you don't even have the $4,000 or $5,000 to put in, guess what? If you have at least $4,000 or $5,000 inside the cash in your plan, you just borrow from the cash that's in your account to then pay it right back in. So it's kind of like taking money out of your savings to put right back into savings again, right? So it's kind of cool. You can actually get to keep paying for itself for a long, long time. By the way, you don't have to pay into these things forever, despite what they tell you. You don't have to pay into this for your whole life. You can actually set it up to where you pay in only about 7 years and then stop for the rest of your life while it's guaranteed to keep growing. So there's so much flexibility when you do it the right way, especially with this max ROI strategy. It makes it so much easier to make it to where you can be flexible, you can put in a lot more, but also keep it to where you're not required to have to pay in a lot more too. By the way, here's a key point for you as well, a little bonus. The way we set up our plans, you can always pay less, but you can never pay more. So if you set that limit at $20,000 a year, that is the limit. You try to go above that by even a couple pennies, and all of a sudden it breaks. It basically becomes a taxable, like an IRA at that point. So you do not want to do that. You don't want to lose those benefits. So we always set that limit at a point that's comfortable, that's not as much as what you're saving. So if you're saving, like I said, $20,000 a year, we'll probably only have you put in $15,000 or $16,000 a year max. And then your minimum is going to be much lower. But if you try to put in more than that $15,000 or $16,000, it will break. So we don't do that. Here's the good news. if your cash flow continues to increase, which most of our clients' cash flow does increase over time, the good news is this: you can always get another one. There's no limit to the number of policies you can get. You can keep getting them forever and ever, as long as you don't exceed a certain death benefit in your situation. And just so you know, we always get usually the lower death benefit that you need anyways to allow the maximum cash growth. So most people never usually run into that problem anyways. So that's the good news. So point number one, I talked about who's this not for. Point number two is how much savings do you need to have to start these? Point number three, of course, was what's the max that you can actually do, which really, by the way, the max is about 25% of your stated gross annual income. And then the fourth point here, what do you want to do with this policy? What is the real purpose? Now for me, I want the death benefit. Yes, I want to protect my family because I know that's money that allows me to spend while I'm alive. And then whatever bills I have left over, great, the insurance can pay that off. Heck, I don't have to pay off my mortgage. I can keep investing the money that I would use to pay off my house and make way more money than I would paying off my house anyways, and still have a life insurance policy to pay off my house, any debts that I have if I decide to keep them because they're low interest rate debts. However, the other reason for me is I like to have cash reserves that are liquid but pay me more than 0.nothing% at the bank. There's also other aspects, like I've talked about how you can double dip, make money in two places at the same time because of the way you use this policy. You can actually borrow from the insurance company to then go and invest that money, and then they're also paying you on this side while you're earning money over here too. So there's lots of ways to use it. You might use it because you want to grow your business, like many examples I've given before. You might want to use this money in a way that really allows you to keep building your assets, right? To keep growing and building. I have one client, he wants to buy one new investment property every single year using his plan. There could be a lot of reasons. It might just be for peace of mind, just to have some liquid cash. Some people just want some cash that's not sitting around making nothing. Whatever your reason is, it's perfect. But know what you want to use it for, because knowing what you want to use it for will determine how you're able to use it and what's the best strategy for you. And that's my last challenge to you guys. If you want to figure out how to use this, again, reach out to us, moneyripples.com. You can book a call with one of our specialists to find out how to design it to be the best fit for you, not for the insurance agent, but for you, to make sure you get the best bang for your buck with the policy you're trying to create. Reach out to us today.